If you're looking to get up to speed, like really quickly, on one of the most watched stocks out there, well, you've come to the right place. Welcome to the deep dive. Our goal here is always to take these pretty complex financial reports and just boil them down to what you actually need to know. And today, we are definitely digging deep into the Q3 2025 earnings for Netflix, ticker NFLX. This one's really interesting, actually. It's almost a perfect case study because you've got this conflict, right? The company did really well operationally, strong numbers, but the stock still took a hit.
Yeah, that paradox is exactly what we need to unpack. It's our job, really, to cut through all the usual noise, the content buzz, subscriber counts, and find the financial thing that really moved the needle this time. Basically, how did one single item, something totally outside the day-to-day business, manage to overshadow what looked like a really solid quarter?
That's a great way to put it. Okay, so let's kick off with the quick summary then. The TLDR, if you will, revenue first.
Revenue looks good,
Yeah.
really good, actually. They reported about $11.5 billion.
Right, and that's up something like 17% compared to last year.
Exactly, around 17% year-over-year growth. So the business is definitely still expanding.
Yeah,
That top-line number was solid, met expectations. No issues there.
and there's always a but, isn't there?
Yeah, there usually is. The headline grabber, the thing the market reacted to almost instantly, was a surprise on the bottom line, earnings per share, EPS.
Okay.
It came in way below what analysts were expecting. The consensus was looking for about $6.96 per share,
And they delivered.
only $5.87. That's a pretty significant miss.
Yeah.
You see a gap like that, and you know something specific must have happened.
Right, it demands a closer look. And crucially, this wasn't because, Stranger Things flopped or people stopped subscribing.
No, not at all. The culprit was a surprise tax expense,
Yeah.
a big one, $619 million.
Wow.
Yeah, and it relates to an ongoing dispute they have with tax authorities down in Brazil.
So like a legal accounting thing, not an operational slip-up.
Precisely. But when that $619 million hit the books, the reported profit tanked, and boom, shares dropped right away in after-hours trading.
Okay, so let's try and separate that out. Let's talk about the signal first, the actual business momentum that seems pretty strong underneath all this. What are the positive signs for the long haul?
Well, the biggest one is probably just that core ability to grow revenue. That 17% jump we mentioned, that's significant. And it wasn't just a good quarter. Management actually raised their forecast for the full year's revenue.
Oh.
That's a strong signal of confidence.
Yeah, that definitely suggests they see the momentum continuing. And the engine for that is still content, right? What do the sources say about the shows and movies?
Oh, absolutely. Content is still king, no question. Analysts pointed to, ongoing success with big franchises like The Witcher, maybe a big new hit show. Let's call it Galactic Pirates for fun.
Yeah, okay. Galactic Pirates. I like it.
Yeah. These big releases, they drive engagement, keep people watching, keep them subscribed. That supports viewership, which, helps everything from reducing churn to increasing how much money they make per user, the ARTU.
And a big part of that revenue story now is advertising. I remember there was a lot of skepticism early on, like, could Netflix really pull off an ad business? How's that looking?
It's looking more and more like a core part of the strategy, actually.
Yeah.
The ad-supported tier is growing, and it seems to be a key reason behind that positive revenue outlook.
Right.
Management's projecting it's going to scale up quite meaningfully. And this is where we need to maybe simplify a couple of terms analysts use.
Okay, good. Yeah, let's keep it straightforward, but get the detail.
So when people analyze the ad business health, they focus on two main things: fill rates and CPMs.
Okay, fill rates and CPMs.
Fill rates basically just asking, of all the ad slots Netflix has available, how many do they actually sell?
Yeah.
If it's low, they're leaving money on the table.
Makes sense. And CPM.
CPM stands for cost per mil, which is just Latin for thousand. It's how much advertisers are willing to pay for every 1,000 times their ad is shown on Netflix. It measures pricing power.
Got it. So high fill rates mean they're selling lots of ads, and high CPMs mean advertisers are paying a good price for those ads.
Exactly. If both are strong, it shows the ad tier is working well, attracting good advertisers, and really adding to the bottom line.
And the sources suggest those metrics are looking positive.
Yeah, the early signs are good. It really backs up the idea that this isn't just some side project. It's becoming a real scalable business line for them. Operationally, things look pretty robust.
Okay, which inevitably brings us to the other side of the coin. Let's call this segment the profitability shock. You've got this strong growth, good content, a promising ad business taking off. How does one line item, this tax thing in Brazil, manage to derail the whole profit story for the quarter?
Well, it's a fascinating example of how accounting rules, specifically GAAP rules, can sometimes mask what's really happening in the core operations. We should probably touch on GAAP versus non-GAAP here.
Yeah, that feels crucial to understanding this report. Let's simplify that distinction.
Okay, so GAAP, generally accepted accounting principles. That's the official standard. It requires companies to report everything, including weird one-off things like lawsuit settlements, or in this case, this big tax charge related to a legal dispute.
Right, the official audited number.
Exactly. But analysts, and often the company itself, will also talk about non-GAAP earnings. That version tries to strip out those unusual or non-recurring items.
To give you a clearer picture of just the underlying business performance without the noise.
Precisely. So when Netflix reported that $5.87 EPS, that was the GAAP number, the one dragged down by the $619 million Brazil charge.
But if you mentally pull that charge out,
Their non-GAAP earnings, the measure of core profitability, would likely have been much better, probably comfortably beating estimates. It shows the actual operations were humming along quite nicely.
so that huge $619 million charge, because it relates to this Brazil tax thing, had to be included under GAAP rules. It hit the operating margin calculation directly.
Correct. And that's what pulled the official reported bottom line way below what the street expected. It wasn't a failure of the business strategy. It was a consequence of financial reporting rules interacting with a global legal issue.
Okay, but let me push back on that a little. You call it external or one time, but for a massive global company like Netflix operating everywhere, aren't these kinds of international tax disputes, these legal risks, almost becoming, well, a regular cost of doing business? Shouldn't we expect this kind of thing more often?
That is an excellent point, and honestly, it's the critical question this whole episode raises. The Brazil issue is, yeah, a stark reminder. Everyone focuses on the content hits, but for these global giants, dealing with different legal systems, different tax rules, that introduces a constant risk. The sources definitely highlighted this, calling it headline volatility.
And the market really, really hates that kind of volatility, doesn't it? Especially when it messes with profit
Oh,
forecasts.
absolutely. Netflix is seen as a premium growth stock, right?
Yeah.
It trades at a high multiple because investors expect strong, consistent earnings growth.
Priced for perfection almost.
Kind of. So any profit miss, even if you can explain it away with a one-off tax bill like this, it can spook investors. It triggers fears about future earnings consistency.
And that leads to what analysts call multiple re-rating risk. Let's break that down simply. What does that mean in practice for the stock?
Yeah, multiple re-rating risk just means investors might decide the stock isn't worth paying such a high price for anymore. If they start thinking, maybe margins are going to be unpredictable because of content costs, or maybe more of these legal charges will pop up, they'll demand a lower price relative to the company's earnings.
So the price to earnings ratio, for example, shrinks because the future suddenly looks riskier or less certain.
Exactly. They re-rate the stock downwards, demanding a lower valuation multiple.
Okay, that makes the sharp market reaction much clearer, even with the strong revenue. So operations humming, but profitability reports getting choppy because of these international issues. What was the overall take from the analysts who cover Netflix? Let's get into the context and what to watch next.
Well, matching the mixed report, the reaction was pretty mixed too. You basically saw two main camps form.
Okay.
Camp 1 really focused on that GAAP EPS miss. They saw it as proof that margins are just too volatile, maybe management needs tighter financial controls across all these different countries.
Yeah.
They were worried.
And the other camp, what was their view?
They looked past the Brazil charge. They kept their conviction in the core growth story. Add to your success, the ability to raise prices eventually, the strong global content engine.
They saw it as just a blip.
Pretty much. A textbook external shock that you should kind of ignore when you're thinking about the long-term non-GAAP value of the business.
So the general narrative seems to be top line fine, good growth, bottom line messy, clouded by this one-off. Did this actually change analyst ratings much? Like buy, sell, hold?
Mostly no. Most of the big banks stuck with their existing ratings, whether that was neutral or buy. It signals they still believe in the fundamental business. But almost all of them flagged increased risk in their models around margins, and specifically this kind of local tax exposure.
So higher uncertainty baked into their forecasts.
Right. The practical takeaway, that's sort of my take from the sources we read, is pretty clear. Operationally, things look okay, constructive even. But this headline, risk from corporate or legal or tax issues, it's very real. It just shows how these kinds of surprises can completely Well, swamp the operational progress when it comes to the official reported GAAP earnings.
That's a really crucial lesson for anyone following these big global tech companies. Okay, looking forward then. If you're trying to track Netflix from here, what are the key things, like maybe 4 actionable items you should be monitoring?
Okay, 4 things to watch. First, and maybe most obviously, any updates on that Brazil tax dispute. Is there a resolution timeline? Could there be more payments or charges coming? That directly impacts future GAAP UPS. We need closure on that.
Makes sense. Number 2.
Second, you watch the Q4 results, especially revenue and management's guidance for next year. Pay close attention to what they say about the ad revenue momentum.
And maybe the impact of big releases, like you mentioned, Stranger Things, final season potentially landing around then.
Exactly. How are those big content bets translating into revenue and subscriber growth, especially on the ad tier?
Okay, third point.
Third is the overall operating margin trend. Investors really need to see that margin recover after this hit. Is the company managing its content and marketing spending effectively? Are margins expanding again, or is there still pressure maybe from operations or other legal stuff?
Got it. Margin recovery is key. And finally, number 4.
Number 4 brings us back to that crucial ad business. Keep a close eye on those monetization metrics we talked about, the fill rates and the CPMs. Are they improving? Is advertiser demand strong?
Because those numbers really tell you if the ad tier is living up to its long-term potential as a major growth driver.
Precisely. Those are the barometers for the future revenue upside from advertising.
Okay, that's super helpful. This has been, yeah, a really insightful look at how these global financial complexities create real risk. So the final crisp summary headline to remember is probably this. Netflix grew revenue strongly, up 17%. But a surprise, $619 million Brazil tax hit crushed the official GAAP EPS, missing expectations. Operational momentum looks good, but keep a close watch on margin headlines and international legal risks.
That sums it up well. And maybe if we just zoom out for a final thought, this whole episode really underlines something important. To truly grasp a global powerhouse like Netflix today, you need to pay just as much attention to things like international tax law and jurisdictional compliance as you do to, say, their next hit show. Which leaves us with a question for you, the listener, to maybe ponder. In this globalized world where almost every major company operates everywhere, should investors start valuing companies less on just their content wins or product buzz, and maybe more on their proven ability to navigate and minimize these complex international legal and tax risks?
That definitely shifts the focus, doesn't it? Suddenly, legal and compliance expertise becomes almost as important as creative genius. A lot to think about there. Thanks for joining us as we unpack the risks and realities of the modern global market. We'll catch you next time for the next deep dive.